hear you.
Good afternoon, everyone. Thank you so much for being here. I really hope you're having a wonderful start to the new year. I have no doubt that 2021 is going to be a breakthrough year for all of us. It's been a highly productive January for us, and I hope that sets the tone for the next 11 months. As we say here, new year, new opportunities. Thank you so much for taking the time to join us today. We really appreciate your attention and your willingness to participate. My name is Akshay Sardana, and I'm the VP of International Development and Strategy at the Continental Group. A brief intro of who we are for those of you who don't know us. For the past 25 years, we have been supporting our partners and our clients with access to innovative solutions and world-class service standards. At Continental, we deeply understand the needs of our clients and go the extra mile to position the most relevant solutions. And along the way, we've developed a strong expertise and a proven track record of generating consistent growth for our clients. We're extremely passionate about what we do, and hopefully that comes across in the content and the speakers we have lined up for you today. Our goal is to support you with actionable ideas you can build into your portfolio in 2021 and beyond, while being fully transparent and hopefully having some fun along the way. Today's session is conducted in partnership with the NJ Group. They are one of India's largest financial services conglomerate and have been named Asia's largest investment advisor network with 26 years of legacy. They have a presence in over 100 locations in India and 10 more internationally. More than 3 million clients trust them with their wealth, and they manage assets in excess of 12.5 billion US dollars. And now on to our experts. First on the agenda, I'm delighted to introduce Mr. Anand Shah. Mr. Shah is the CEO of NJ Asset Management. He is one of India's most respected fund management professionals with over 20 plus years of experience. He has been recognized with the CIO of the Year award by Asia Asset Management and has worked in leadership positions in various leading asset management companies like ICICI Prudential, Kotak Mahindra, and in his last assignment, he was the Deputy CEO and Head of Investments with BNP Paribas Mutual Fund. As the CEO of NJ Asset Management, he brings a unique combination of 20 plus years top-down fund management experience driven by the investment approach that's simple, disciplined, and rules-based. Our second expert speaker is Mr. Anand Varadarajan, General Manager, NJ Asset Management. Anand is a global financial services, investment management, and advisory professional with close to 20 years experience. He's been awarded the prestigious 40 under 40 for top investment professionals in India. He has a proven track record of having set up, built, and managed sales infrastructure with various global companies such as GE, HSBC, Kavi, and BNP Paribas. He's been leading the sales and product management activities at NJ since 2016. Under his leadership, they've been able to establish their positioning as a pure rules-based fund house and have helped NJ Asset Management carve a niche in their marketplace. I hope you're all looking forward to their insights into the opportunities of the coming year as much as I am. Also on the panel today, I'm privileged to introduce our very own Neelam Varma. She is the Vice President and Head of Investments at the Continental Group. Neelam is a seasoned finance and banking professional with over 23 years of experience across investments, private banking and wealth management, corporate and commercial banking, retail banking, and Islamic banking across India and the UAE. She has built her expertise and career working in multiple senior positions across global banks like Citibank, HDFC Bank, First Gulf Bank, just to name a few. We are giving you unrivaled access to these three experts in their fields, and we encourage you to ask them challenging questions and provide us with any feedback so we can keep improving. And on that note, I really hope you enjoyed today's session. We are here to share ideas, collaborate, and to help add value wherever we can. I would like to open the floor to Mr. Ashok Sardana, the founder of Continental, to give you some more insight into our unique approach to creating impactful lifetime relationships. Thank you very much.
Thank you, Akshay. Welcome, everyone. I just want to share with you my story with NJ. About 15 years ago, I think 15, 16, 17 years ago, we were invited to Surat by Mr. Neeraj and Mr. Jignesh, the founders of NJ. Of course, we had all vegetarian meals. And, but the reason why we collaborated with them, and I'm proud to say, I could see the passion in their eyes. I could see the passion that, first of all, they were talking about technology which 15 years ago we hadn't heard of, and they wanted to scale up the organization. And I'm so proud to say that we are we have a long standing relationship with NJ, because the ethos of Continental and ethos of NJ are the same. How can we add value for our clients? How can we do something, and how can we do something for the clients? And it's based on trust, confidence, transparency, and thank you, NJ, for choosing Continental, and I'm looking forward to the next 25 years and beyond. Thank you.
Yep. Thank you, Mr. Ashok. I'd like to introduce myself. I'm Anselm. I look after the sales and distribution for Continental, and I'm going to be your moderator for the evening. I hope to be able to host you and bring about an interesting and maybe enlightening discussion from our panelists. So, a bit of a housekeeping before we get into um the actual discussion. We have about 30 minutes planned for the seminar, followed by, or for the webinar rather, followed by a question and answer session for each of you. Just to keep you aware that this is being recorded, and the recording will be shared with you post the event. If you'd like a copy of the recording, and if you haven't received it, feel free to either drop a message to the team or to one of your advisors within Continental. So we're always excited to hear from you, to receive your questions, to make it as interactive as possible. So please do feel free to utilize the chat box, which is there on your screen, and type in the question and answer. So the box would be titled, or the icon would be titled Q&A. So do put in your queries there. We will endeavor to answer all of the queries. However, if we are unable to get through to some, we will make sure that we send you a response post the event to your query. And with that, I'm going to kick things off. Of course, uh, the title of today's webinar is What's Up India? It's a deep dive into the Indian markets. And as Akshay has mentioned and introduced, we've got a good selection of knowledgeable speakers to be able to talk about that. And while before we get to the question, I'm just going to sort of put this out there. You know, until December 2019, 2020 meant something completely different. Yeah. Or the phrase 2020 was probably a reminder of, you know, T20, the cricket that we used to sort of all watch and enjoy, the format, which I think all of us love. For us in the UAE, 2020 was more or less associated with Expo to a large degree, but 2020 came and shook things up, and I mean, I don't think any of us imagined at that point of time that the year was going to turn out in the manner in which it did. It shook up many things, and uprooted the normal. It taught us a great deal. It accelerated the adoption of technology fantastically. It has had both its share of ups and downs. And whichever way you look at it, it has been a remarkable year for everyone. The markets did something that I don't think many of us expected. And that's where I'd like to sort of start and go to Mr. Anand Shah, that in the backdrop of COVID, of 2020, there has been, of course, a lot of impact in India that we've seen. And we've seen it start on a little shaky foot and then grow in confidence. And today we are seeing a response that I think a lot of us are proud of. I'd like to pick your thoughts on, you know, the impact that you've seen in 2020, and, you know, correlate that to the Indian markets and the performance of the market.
Sure. Thanks, Anslim. First of all, thank you, Akshay. Thank you, Ashok sir, for the kind words. Thank you for having us. We at NJ are also very proud to be associated with Continental Group, and we cherish this partnership. Islam, before I move on to the performance of the markets, I think one needs to understand what COVID has done. And I think social distancing is the key word. I think to make sure that this pandemic doesn't spread, and I think the world has done a good job bearing some pockets. What it has done is it has sort of accelerated certain trends. Whatever we could do uh, without interacting with somebody else has actually accelerated, and we have seen, be it online shopping or be it watching entertainment within the four walls of your home, and so on and so forth. And all the companies and the sectors which sort of supported it got actually boost from. I'm a little sad to say that, but so be it. But certain companies and certain sectors actually benefited, whereas a certain businesses, like tourism, like hotel, restaurants, they've been severely hurt, and they will take a while to come back. With that backdrop, if you see, the overall markets also globally also, if you see, it's no different in India, but the best performing markets have been the Nasdaq and Kospi, which have been very, very technology dominated. No different in India also. In India, a lot of market recovery, if you see, would have. So the broader market might not be back up as much we see as a index. It's the pockets of the market which have sort of got re-rated or appreciated significantly. Part of that has also to do with the low cost of money, significant pumping of liquidity by central banks, which has led to a little re-rating in sectors which have sort of benefited. So if I break down the Indian markets also, which for the calendar year 2020 looks up something like 24, 25 odd percent. The healthcare and IT are actually up more than 50%. And banking sector, which is sort of leveraged, is yet to come back. It's sort of flattened out. Some of the companies which were very leveraged will be significantly impacted. Some of them will actually not come back. Some of the sectors like consumer durables, consumer non-durables, they have come back, and they've sort of, understood the new nuances, new ways of doing business, and to that extent, those companies are also back. So, if I were to sum it up from the Indian markets perspective, it reflects what's happening in economy. Some of the businesses doing actually better, and they've got sort of re-rated. Some of the businesses were down for a while, which we saw when in the March, all the sectors got corrected, like consumers, durables, non-durables. They have come back with a vengeance, if I were to say. But some of the sectors are still lagging, and they will take a while to come back. That sort of sums up what the market is.
Sure. Thank you so much for that. I think that's a great place to start. A good overview of the different sectors and what we've seen, where gains have been made. I'm going to go to your colleague, Mr. Anand Varadarajan, and just pose this question to him in context of COVID. There has been an impact on the ground level. You're close to based out of India. You're close to the ground level, and you've seen a couple of things that the challenges that may have been there on ground from an organizational perspective. And if you can share some of your thoughts on that, and also from an investor perspective, what have you seen from the investors from a reaction to COVID and the impact that is being having?
Right. Thank you very much, Anselm, for bringing up this question to me. As you rightly pointed out in the beginning of your briefing, COVID-19 and the year 2020 posed a whole new set of challenges, and it did give a lot of enterprises around the world a reality check of how the world would look if we were supposed to be in a state of lockdown. And when you talk about situations like these, we talk about, whenever we talk about investments, we talk about saving for the rainy day. So what did happen, and we did see this issue across the industry in India and around the world as well, wherever we are servicing our customers, is to see that when there is need, people were out of jobs, people weren't earning money. So they did save their money for these kind of rainy days. So we did see that in the marketplace, there was a lot of issue with people not being able to get access to their money in terms of, to be able to redeem, to be able to cater to their transactions and so on. So what we did see, the first 3 days, we started the lockdown on 22nd March in India. So if you look at the first 3 to 4 days itself, because we are somebody as an enterprise who believe in a digital platform and making sure that all transactions are processed and maintained digitally. So the first 3-4 days itself, we saw that over 4,000 calls of investors were managed through our call centers, which were decentralized at the agent's residence in 3 days under complete lockdown. 4,000 plus calls taken. Close to about 7,000 plus new SIPs were registered. Close to about 125,000 mutual fund transactions were processed. Close to about 120 plus transactions were processed on the stock exchange. So with about 3 million investors that we have today, close to about 2.2 million investors, or a little around that number, are already on our technology platform. So that has enabled that people still continue to have control on the money when they want to have it, and still were able to keep track of how their investments were performing during these times. So I think the message that we've been driving for a very long time into our business is it's important to go digital, it's important to go paperless. So I think while the entire market, a lot of the peers in the industry were impacted, I think our business did grow to the next level. We did have, in those 3 days, we had about 3,500 to 4,000 new accounts also getting activated where people were moving online. So I think it did give a wake-up call. It's a new definition of how this business is going to work going forward.
Thank you so much. Thank you very much for that. I think it's a good overview, and it's good to see that there has been a silver lining to all of this at the end of the day. And I'm going to switch to Neelam to give us a perspective from the UAE side. I mean, this was a global phenomenon, no doubt about that, and we've seen how India and the market there and the investors there have coped. What was your experience here in the UAE?
Thank you, Ansalam, for the question. I think the experience was very much similar to what the world was facing in Dubai. In UAE in particular, we had almost 98% of the workforce within Continental working from office when the year started. And come March, when the COVID situation started getting worse, I think most of these staff started working remotely. We realized at Continental that we were more than prepared to do this because of the technology, the infrastructure that we carried over the years. A lot of times, a lot of companies do not have that strength to transition that smoothly and that rapidly. So that helped. We internally started meeting within the investment department to take stock of the situation, take stock of the markets, to ensure that the clients' monies were protected. What also happened was that clients started hesitating meeting face-to-face. And because of the technology that we carried, we immediately started meeting clients virtually through different platforms. Client transactions were impacted because a lot of our team was not able to go and meet clients. However, I think at the back end, our operations was geared up to process these transactions within the stipulated times to ensure that the client's expectations were met and were actually enhanced during this time. A lot of handholding was done within Continental with our clients. And I think that led to a lot of growth in the business over the year. So if I have to look at 2020 for Continental, it has been a remarkable, memorable year when the markets changed dramatically, wherein the clients' mindsets changed dramatically. Clients started looking at investments as a very, very serious way of saving, which was not the case before. So I think we've gone through a lot of change, and I'm happy that Continental could actually manage to sail through in a very, very strong way. Thank you.
Thank you.
Yes, I mean, I just were to, sorry, but
yes,
if
please.
I were to just add to both Anand and Neelam's point is, also, we've seen same thing in the businesses also. The businesses which were ready with their IT capability and all that, actually benefited. So within the same sector also, there has been a difference in terms of how businesses have fared. And
Yes.
a lot of people are surprised with the recovery in equity markets, but equity markets represents a lot organized sectors and businesses which are future ready, a lot suffering or because of the pandemic, and lot losses because of pandemic lies more in the unorganized sector, which actually are not listed. So it so happens that every time you have big crisis, you actually see markets going back up to the higher levels post the crisis, because the listed space is more organized and future ready than the unorganized space, and that's how it gains more market share. And that's what we are seeing in many many sectors, where the organized sector is gaining market share from unorganized.
That is so true, and thank you for that insight. I think it answers so many questions for many of our colleagues who've tuned in and our clients who've tuned in. Thank you for that, Mr. Anand. We have a poll coming up for our attendees. So if our team will put the poll on the screen, there you go. It's related to the pandemic and investments. How did COVID-19 influence your investments in the stock market or in the markets? Did you exit fearing a collapse? Did you stay put? Or did you invest more on the dip? So do take that poll and uh, 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 put in your answer so that we can get a sense of what the actions from our colleagues and clients were. I think that is going to be up for a minute before it closes, so do get your answers in. In the meantime, we're going to move to the next question that we've got, and this is a question that is going to be put across to um, our very own Mr. Ashok. Um, we've, we know that you've got a long history and record with regard to investments in India. India, obviously, being home for a lot of us. So if you could share a little bit about your investment journey in the investment markets and in India in specific, what do you feel about it, and share your philosophy with the listeners.
I will be very happy to send anyone. I am happy to share my portfolio. My portfolio is with NGO, and I think over the last 2, 3, 4 years they've given us a lot of so when I've invested the money and I go to sleep at night, I don't have to worry. I don't have to worry about what's happening in COVID and what's happening in the market. I know it is there. I know it is stable. There's a stable growth. So I sleep like a baby at night. So if anyone wants, I can send them the copy of my portfolio to see that how the funds are performed. Yeah, COVID or no COVID, uh, we have to invest. If you see 2008, the market collapsed, it rebounded. 9/11, the market collapsed, it rebounded. COVID will also pass by, it'll rebound, and again we will think, oh, I wish I had invested when the market was down. This is the time to invest. Stay long, stay there, and enjoy the weather.
I love that. I love that. Thank you. Thank you so much for that. We've got the results of our poll, and there they are on screen for you. So proud of you. Just under 4% who exited fearing a collapse. 14% stayed put, which is a wise thing to do. And I think probably the better thing to do was by 46%, 50% stayed put, and 46% invested more during the dip. So a very sensible set of investors that we've got tuned into this. And I'm going to go to Neelam. Neelam, of course, your investments is your day and night, your bread and butter, the thing that you wake up to. Would you like to share your feedback with regard to the Indian markets and your personal stories with regard to investing there?
Sure, Anselm. While the global markets remain, the forefront of the investment business, India seems to be very close to my heart. I've been very passionate about the Indian markets, having lived there, studied there for most of my life, and worked there. Uh, for me, Indian markets give the opportunity which no other market presents: the depth, the size of the Indian markets, the variety that you get in India, I think is unprecedented with any other market. Uh, my investment portfolio, like Mr. Ashok said, also is open for a check because I've been investing at all dips. I have portfolio across SIPs. I do a lot of lump sums. I invest in direct stocks. So it's a mix of all sorts of asset classes that I carry. I'm happy to say that my portfolio has done well in the last 1 year. It's done phenomenally well, I must say. And the ones that I've been holding for years has outperformed any of the numbers that I could have imagined. Let me put it across that way. So the SIPs have definitely worked for me. Uh, Buying on dips has definitely worked for me. And this is what I recommend to our clients, that look at the opportunity. Don't worry when the markets are down. Stay put. If you have funds, invest. Seek that opportunity which the market presents to you. So whenever there is fear, this is the common thing that I tell. Whenever there is fear, enter. Whenever there's greed, exit. So that stays. Thank you.
Wise words indeed, and I think very sensible approach as well. Thank you for sharing that. And that sort of offers a perfect segue to my next question, which is to Mr. Anand Shah. You did touch upon the outlook a bit on the different sectors. Whether it was healthcare or some of the others that you mentioned. I wanted to sort of pick your brains a little more and go into a little more detail in terms of 2021. The year past is gone. It's good to examine it for a little bit of time, but the focus is obviously always going to be on the future. So what are your views with regard to 2021? Whether you want to look at it from a sectoral perspective, if you want to look at it from an instrument perspective, whether it should be equities, mutual funds, I'm leaving the floor open to you. Of course, you're the expert. How would you like to approach it, and what would your advice be to our listeners?
Sorry, I was on mute. So I think as far as equities is concerned, it's sort of a place where you will have to stay. I think that's one of the asset classes which you can't ignore. You can ignore at your own risk, because investing in equity might be risky, but not investing in equity is definitely risky. Because over many years to come, you will have inflation to deal with, you will have lifestyle inflation to deal with, and you will want your savings to earn for you. And that's what Warren Buffett says, that if your money is not earning more in the night when you're sleeping, then you will have to work that longer, or maybe you'll have to work till the end. And to that extent, equity as an asset class you can't ignore. India definitely, as Neelam said, offers you a distinct opportunity in India. I think demographics is for sure. Everybody knows it's 1.3 billion strong, but also a fairly young population. The dependency ratio is falling, which means that your per capita income will rise rapidly as the population growth rate sort of slows down and goes more towards zero. So I think that's very positive. You have democracy. I think that's another big plus as far as India is concerned. Not many emerging market economies offers you that. The law of the land works. The institutions like judiciary, the institutions like administrative services, they all keep a tab on each other. And to that extent, there's sort of, you have an emerging market with a lot what you get in the developed world, which is democracy, institutions, and others. So in a way, it's a unique opportunity within emerging markets where you have growth, you have stability. I would definitely urge people to understand that the noise is not equal to instability. At times, a lack of noise can be an underlying a lot instability, as we saw in quite a few emerging markets last 1 decade, where you had coups and others. Here, people can vent out. The democracy allows you to do that, and to that extent, it provides a significant stability. So on that sort of a background, also what India offers significantly better than other emerging markets is private sector. If you see in many other emerging markets, state-owned enterprises dominate the markets in various sectors, And to that extent, they might look relatively cheap on price earnings multiple, but India, more than 90% of its index is private sector. Its services, its consumption, uh, it's less of commodities, less of cyclicals. It's more of secular growth stories, and that's been the case over last 2 decades that it's come about. India also had a lot of state-owned enterprises, a lot of cyclicals, a lot of commodities into its index in 90s and 2000s. But over time, we have seen the more successful businesses have gained their weightage. So IT services, private sector banks, consumers like the MNCs like Unilevers and Nestle's, they form the part of the benchmark. And to that extent, India offers you growth, offers you stability and quality. I think, and quality has been rewarded like anything in the last decade. And I don't see any reason why it will not get rewarded in the future also. So a high ROCE, good return on capital investments, fairly low cyclicality. Uh, Capex is not very high in these businesses, and to that extent, they trade at a premium. So, yeah, one negative of Indian markets, which people keep on highlighting, is a higher P multiple versus other emerging markets. But I just wanted to give you a backdrop why India actually trades at a premium because of growth and quality of businesses which comprise of its benchmark. Talking of 2021, I think we will see recovery in earnings. We will see, and globally as well as in India. The expectation from India is huge in terms of growth. India has not really spent a lot of money. The fiscal deficit, like we have seen fiscal stimulus in many developed world and certain emerging markets also, India has recovered without much of a fiscal spend. Hopefully, we will see some of that in this budget. I'm not hoping too much from this budget, but nevertheless, unlike in last 6 years, government has been very focused on fiscal deficit, which is a very good thing. But I believe some of the money would be spent to kickstart the economy. So that also in a way is a little bit positive for equities in this year. But I think from here on, stock picking will be important. One will need to see where certain companies are trading at a significant valuation. So you will have to be careful about it. But nevertheless, overall, the outlook remains positive for the markets.
Thank you so much. That is great to hear, and I think everyone agrees. I can see many nodding heads there. So certainly, not just agreeing, but I think that's a lot of hope coming in from the year that we have. We're going to go to Neelam. Before I do that, I'm just going to quickly remind our audience members that the question and answers box is available. If you have any questions at any point of time, feel free to add them in during the session so that we can get to them once the panel discussion has ended. So just a reminder that you can submit your questions in the Q&A box. Neelam, going to go to you with the same question, but from a perspective of clients. I mean, as as a frontliner, Continental has been looking and talking to clients from different spectrums and different sides and sectors of the scale. So, what are you seeing, and with regard to the outlook coming in for 2021? And how, are you looking at SIPs, lump sums? Do you look at SIPs? How do they how do they perform in challenging times? If you could share some of your thoughts on those.
Sure, Anselm. So at Continental, our ethos stays, that's clients first. We continue to maintain that ethos during 2020 when the times were testing. Clients were happy because the worst of 2020 was actually taken care by the performance of the markets. At Continental, what we did was we actually were in constant touch with our clients. The change of being in touch was that it was through emails, it was through virtual meetings. We conducted a lot of portfolio reviews. We were in touch with the clients to suggest any real allocations that were required in their portfolios. We looked at the changing market dynamics. Bearing that in mind, I think one more important thing that was happening was that we at Continental were not able to sit down together and meet up and see each other face to face to discuss the strategy forward. So what we started was to have daily huddles, daily stand-ups, so that the spirit of the team was high to take care of our clients. And that actually helped us to go through the lockdown, the remote working. It made us much more stronger to deal with the client's requirements. I personally feel that with this as a backdrop, this year 2021 is going to be a rock solid year for Continental and its clients. We've created the changes, we've actually enhanced the strategies as and when required for our clients' portfolios. Uh, I think we will plan on continuing with the stronger infrastructure that we have. We'll try and strengthen there. We'll try and stay connected with our clients to enhance their client experience as we go along into the new year. Uh, the addition that we've done is by way of client engagement. We've started hosting a lot more webinars wherein the information is actually transmitted to clients across different market segments. We did one webinar last month. This is the second one which we are catering to our clients on the Indian market. So these client engagements would continue through the 2021 and I think the coming years till we see the change happening wherein we can do live seminars for our clients. I think our team is agile enough to understand and respond very, very quickly to the changing market dynamics. Our products are rapidly evolving. We have a larger suite of products to offer to our clients, which actually are in line with the markets today. We are looking at also enhancing our relationships further. I think our relationship with NJ, who's an existing partner of ours, is further strengthened by getting more investments into their products. We're tying up with more providers. On your question about SIPs and lump sums, I think SIP is a very unique way of riding through the ups and downs of the markets. And clients who feel that they would not want to invest at one time should definitely go into a systematic investment plan and invest regularly. Larger one-time premiums or lump sum options are always available. We need to monitor the portfolios though, so we continue to do that at Continental as and when we feel that there's a need or the client wants. However, having said that, we have an internal calendar in place to monitor the portfolios. I feel personally this is going to be a great year for all of us put together, and we need to continue what we've done in 2020 a little better. Thank you.
My apologies. All right. Thank you. Thank you, Neelam. Thank you for that. We've got our next poll question ready for you. And there you go. I think Mr. Anand Shah did touch upon it briefly with regard to the upcoming budget. Question to our audience is, do you expect the finance minister to introduce a COVID tax or surcharge on income tax in the coming budget? We would be very curious to know what your thoughts are. And of course, a lot of us are waiting for the budget to understand the answer, but we'd like to hear your sentiment on that. We'll give you a minute to answer that. And in the meantime, we're going to go back to Mr. Anand Shah once again to look at the global canvas. We've seen India play an increasingly important role on the global stage. We're seeing the growth story, the IMF talking about India, and there are a lot of expectations from India. How do you see this panning out in the next 5, 10, 15 years? If you could give us a sense of, India and what we should be looking out for, what we can see as the future, where do you see India going? Either from an economic or perspective or even from a market perspective. What is next for India?
Sorry. Yeah, my apologies. I think, as I said, the India's growth story in coming decades will be no different from what we have seen in other parts of the world. I think such a large population, whenever its dependency ratio falls, means when its ratio of earning members to dependents increase very clearly. This has happened in US, it's happened in Southeast Asia, it happened more recently in China after it sort of implemented the one-child policy. India is no different. Without a one-child policy, we are moving towards where your dependency ratio is falling, your earning members per family is going up, dependents are coming down, which means more money to spend. On top of it, the leverage is quite low. The Indian household is not leveraged. So a combination of a falling dependency ratio, rising per capita income with a very little leverage, very clearly India offers a huge demand opportunity for the rest of the world. And I don't think it's lost on any of the corporates globally, be it consumer staples like Nestle's and Unilever's of the world, but it's not lost to the Facebooks and the Googles of the world. So one part of the story of India for the global world is the consumption demand. It's a demand. Even the tourism and other places, India can offer a lot. Uh, but I think the other one, which is more recent, and it's been sort of a very slow start still, but India also offers you labor, a large pool of labor, and especially at a point of time when China would actually be losing, or rather will have a lower number of people available for the labor work, because they're reaching a point where they'll have more elderly people and less youngsters. So they're aging rapidly. And to that extent, their pool of labor will actually diminish over next decade, where India will be able to provide you more labor. So manufacturing is a big opportunity. From the very beginning, this government's been talking about Make in India, talking about Atmanirbhar more recently, very clearly. So along with demand for the goods and services, we can also manufacture a lot and not only sell within, but also sell globally. So I think that's another big opportunity for India. We are seeing significant growth in FDI. A lot of global companies are de-risking or having a sole manufacturing units in China, are moving to India, having a second manufacturing setup here. We have seen some geopolitical tensions, which is also leading to the companies looking at India. India is also providing more tax benefits for the new setups here. So I think over the next few years, you would see that accelerating rapidly. COVID was sort of a spoiler in that sense that it lost some momentum, but I think we are on the right track. So the manufacturing in India will also pick up. That will also provide a lot of jobs, which will further boost the consumption story. So I think from India's perspective, India remains a large services and consumer economy today, a very small manufacturing and further smaller agri. We are working towards making the manufacturing big, making agriculture big also. And to that extent, that's another opportunity which sort of can continue to help. And it will throw up few corporates and few sectors also to look up to. So from a equity markets perspective, we continue to like the consumption services space, but we're also looking at select opportunities in manufacturing and farm produce or farm support companies like fertilizers and others.
Yeah, a lot of food for thought over there. Thank you. Thank you for the question. We've got the poll results that we can share with you that will be coming up on screen in just a second. So 27% of our audience thinks yes, there is going to be a COVID tax or surcharge. 35% don't think so, and 38% are I can't say it, so they're going to adopt a wait and watch. So that is interesting. We have another poll that is there that sort of fits in, and that's up on your screen again. Which industries, according to you, would perform well in 2021? So trying to get a sense from the audience as to where their thoughts are on that. So you've got a couple of minutes to answer this while we go to our next question. And I think we've had that sort of covered the markets, the market outlooks, and the economy. I'm going to go to I'm going to go to Anand Varadarajan for a question on the asset allocation sort of structure. I mean, I've heard you speak about dynamic asset allocation. I've been familiar with passive and active as asset allocation strategies. Curious to sort of hear from you as to what, when you discuss dynamic asset allocation, what does that mean? And if you can share the perspective with our attendees as well.
Right. Thank you very much, Anselm. A couple of quick points, that I would like to enlist here. First is that when you talk about equity markets, if you look at the long-term return of Sensex, or you look at the long-term returns of the broader indices in India, the Nifty or Sensex has definitely delivered a return of about 12 to 13% if you look at it over a long term. But today, if you go down to an investor and see what is the return that their portfolios have generated over a long time, you will see that they will talk about single-digit returns. So if the broader indices are delivering 12 to 13% return, then why are the investors getting only the 7 to 8% or a single-digit return? That's the point to really ponder about. The reason why there is a gap between the 3 to 4% gap between what the market offers or what the broad market indices are offering versus what the investors are getting is exactly the point which Neelam mentioned. It's the issue of the vicious cycle of fear and greed. Okay, so when the markets are going up, the perceived risk is low, but at that time the people are going to enter the market at higher valuation. But when the markets are falling, that's the time when the market valuations are low, and that is the time when people should enter. But that's actually a time when people are coming out. So we need to make sure that we step back from having our investment decisions becoming emotional and stay away from the vicious cycle of fear and greed. So that's my first point. I'll then go to the second point, which Anand did mention. And a lot of investors today, when we speak around the world, talk about the markets being very high and very overvalued at this stage. So they're saying that we'll wait for the right opportunity. So like Mr. Sardana also mentioned, so we will always keep looking, the investors will always keep looking at an opportunity to say, now the market will go down and then I'm going to invest. So, our colleague and CEO, Mr. Anand Shah, keeps saying that in his 25 years of investment cycle as a fund manager and having, led investment decisions in different asset management companies, or myself, when I look at buying any commodity for myself, I've seen that if I buy something at a higher price, I don't end up buying a bad product. Okay, there will be a time when we will really feel that probably we've paid a higher price for the commodity or for the security that we're buying. But normally we see that anything that comes at a premium to its fair price is definitely not a good item to buy. It's definitely a better quality product or a better quality item to buy. So valuations is a big journey, is a big story that everybody keeps talking about. But when we remain patient, I think over a longer period of time, it does create immense wealth. So now coming back to the most important point, while we see that equities and equity, another point which we mentioned is investing in equity markets may be risky, but not investing in equity markets is definitely risky. So when you look at it from that perspective, it's important to make sure that you get an asset allocation model framed, and it should be a model that you're really able to stay away from the vicious cycle of fear and greed. So what we've done at NJ as a part of our rules-based and dynamic asset allocation approach is most of the products and advisory portfolios that we build are built on the concept of dynamic asset allocation, where we see that when the market cycles are going up, when the market is in an upward trend, we systematically book profits on equity and move into debt to make sure that there is capital preservation. Because we often see, and it's always been true around the world, that when the market reaches a very high stage, there is every possibility that it starts coming down and the downturn actually starts thereon. So the markets are going up, it gives us an opportunity to book profits on equity and go into a safer zone. So in our dynamic asset allocation model, when the market cycles are going up, we book profits on equity and go into a parking zone in the form of debt or arbitrage. And when the market cycles are reversing, okay, it so happens that then when the markets are becoming cheaper and when the perceived risk in the market is lowered, we then go buy equity at undervaluation. So typically a very, very close example that I must give you, which is very recent. 2017, we saw the market in a crazy bull run. 2018, we saw that the market tanked. Okay, 2018, we saw that the markets went up. Okay, so 2018, we made sure that we gained control of the portfolio where the valuations were high. Still, the market was looking dangerous at that point in time. So we reduced our equity exposure. 2019, we further stayed put. 2020, when the COVID impact started coming in, when the market, when the COVID impact started coming down and the market started recovering, at that time we went overweight on equity. So what is important to remember is when the markets are expensive, book profits on equity, go into a safer zone. When markets are cheaper, go overweight on equity and buy it at an undervaluation. So that's the bottom line that I'd like to drive.
That's very, very interesting. Thank you so much for sharing that. And it's great to know that the strategy is being followed. We've got, so thank you again. We've got the results of our previous poll up there. According to the audience, 40% believe that technology and 40% believe that pharmaceuticals and healthcare, no surprise there, will fare well in 2021, while 12% putting their bets on banking and finance and 8% on infrastructure. So yes, that's always interesting to hear. We've got a few questions from the audience, and just a reminder, the Q&A box is open. We're taking questions from the audience. There is the first question that's coming up on your screen. What are the tax implications on dollar-denominated investments for non-UAE residents? I'm assuming that that is going to be for UAE residents. And I would like to put that across to the panel, if anyone would like to take that question.
Yeah, so if I can come in, I'll allow Neelam to answer it as well. But today, if you look at investments which UAE residents are making, which are targeted to India, okay, for example, we run a couple of structures which are domiciled in Mauritius and other international jurisdictions where people are investing in an international jurisdiction and the money is coming into India. So if people are investing from their NRO accounts in India, which is getting invested in India, the taxation could be higher. But when we talk about people investing from their dollar accounts or a dollar currency coming into India through an international fund structure, investing in dollars, in UAE, there is no tax implication, but at a fund level, there is a taxation involved. But then there is a long-term, short-term capital gain tax, which is taken care at the fund level. For the investor on the ground in UAE, there is no tax implication on that.
Sure. Neelam, would you like to give a quick follow-up to that?
I endorse what Anand says. I don't think there are any tax implications for clients who are based in UAE as non-resident Indians. They're free to invest into any dollar-denominated products, provided the amounts are actually coming in from their local accounts within UAE.
Perfect. Thank you for that. And we will go to the next question from the audience that we've got, and that's coming up on your screen right now. In this market, which is already relatively high, how do you advise we enter at this time or wait for a fall? I know we should not look at time in the market, but should one wait for it? So he knows the answer there, but he's still asking the question. And I think that's similar to a lot of us. We want that reassurance. So I'm going to go to Mr. Anand Shah. Would you like to address this question, please?
I think, thank you for this question, very relevant question. And, this is in the mind of every investor. And nothing wrong with having this doubt in your mind. I think we also a little bit covered that, there is an asset allocation which one can look at. I think Mr. Ashok Sardana said that, at the end of the day, your investment should let you sleep. And to that extent, the risk management is very important. The comfort is very important. So, there's no one answer for everybody. Each individual is different. Each individual's risk appetite is different. His cash flow, his balance sheet is different. His age is different. And to that extent, we'll have to sit across and decide what sort of asset allocation you want to make. If you're zero and you want to start, SIP is a right way to start in any difficult situations like this. So I think I would stop by saying that, yes, equity you need to have in your portfolio. There has to be a discipline in terms of you sit across with your advisor and decide what sort of goals you have and what sort of asset allocations you need. And once you have decided what asset allocation you want, and if there is a gap, you can fill that gap through a STP or a SIP so that you tide over this volatility which exists in the market. Look, volatility you can't avoid. It's the nature of the beast. Equities, if they're not volatile, you need to worry. So if it's volatile, it's fine. It's the nature of that asset class. So, but you can always tide over this volatility through SIP, STP. So asset allocation, SIP, STP to reach your asset allocation and having a long-term commitment to that strategy.
Thank you so much. I think that's a very reassuring answer, and I hope that answered the question for our audience member. We've got a couple of more questions that we'll go to before we hit our time limit. I think just one last question for us from the audience. Just a reminder, if we've not been able to get to your question, we will answer it in an email across to you. Okay, the question is up on screen. Recently, the Indian administration ensured to spend committed to spend $42 billion. In your view, which companies would benefit the most? I'm going to go back to Mr. Anand Shah for this question. If you'd like to, please take an answer.
I think very clearly, if you've seen this government from the day one, they have been focused on infrastructure. And I think that is what one should expect from governments. They need to provide infrastructure, both the legal frameworks, which on the policy level they are doing, but even on the physical infrastructure, be it roads, airports, be it on the railways and other places. And I think a significant has been achieved, but for a country of our size and which is growing at this rate, a lot more can be done. And I think that's the key focus of the government spends as we see. Unlike the other developed nation which had spent more on basically consumption driven, they have really paid money or put money in the hands of the people. This government has not done that much, and to that extent, there are not many natural beneficiaries because it doesn't boost the growth and boost the consumption immediately. But yes, they have put some money in the hands of the farmers more recently. They've put some money in the hands of the people at the bottom of the pyramid. They're not very clearly natural beneficiaries from there because their ability to spend is only so much. But I think select companies in infrastructure are already benefiting from the various spends that's happening. And I think there's no straight line answer, but it's more stock picking. And that's what I would say from here on. There are no easy pickings in the market. One will have to study, analyze, and pick each company on its own merit.
Thank you so much. And we are at time. Of course, we love the engagement and love the questions coming in. And I think it has been an interesting discussion. I'm going to go back to Akshay and to Boss for their closing remarks and for the vote of thanks. Akshay, over to you.
Thank you, everyone. Really insightful, really inspirational. It gives us all hope for the year ahead. Actionable ideas. I think the main takeaway is capitalize on the opportunities now when we can. And yeah, thank you so much. I hope we can do this again. And as Anselm said, any questions we didn't get to or any ideas that come on the back of this and a question gets sparked in the middle of the night, then please do send it to us, and we have access to everyone on the panel, so we will be able to get those answers to you and continue the dialogue. Also, a vote of thanks to Anselm. Thank you for the brilliant moderation. Really kept everyone on point and kept us on time. And thank you for your participation. This is a relationship we hope to foster over the years to come and grow and support each other, and most of all to the clients here on this forum. We're here to support you with anything you need. So thank you for being here, and yeah, let's do this again soon.
Thank you, Akshay. Boss, would you like to give a closing remark?
Yeah, I'd like to thank everyone, the panelists and everyone who's on the webinar. Thank you, Anand and Anand. Thank you, Neelam. Thank you, Anselm. Thank you. Just one thing, there are two kinds of people. The first one, they spend, and they save anything, if anything is left at the end of the month. And the other group is they save first and then they spend. If you want to be successful in your financial planning, start saving first. Start saving first at the top and then spend. And with NJ, we have the SIP model where we can start building our portfolio slowly. Just start somewhere. There is no right time. This is the right time to start saving, right?
Yep.
And thank you very much for the webinar. Thank you, Anand.
Thank you.
Thank you,
Thank
Neelam.
you.
Our pleasure.
Thank you everyone for joining in. Just a reminder, you will have a poll when you exit the conference. Please do answer the question on the poll and leave us with your feedback. We much appreciate you joining us today. Thank you. Have a great evening ahead.
Thank you.
Thank
Thank
you.
Thank
Thank
Bye,
you.
you.
everyone.
Everyone.
Thanks.
Bye.
Bye.